Algorithmic trading, or algo trading, involves using computer algorithms to automate trading processes. These algorithms follow a defined set of instructions to place trades at speeds and frequencies that a human trader cannot match. First, let's understand the core components of algorithmic trading. 1. Algorithm design. This is the blueprint. It involves creating a set of rules based on timing, price, quantity, or any other mathematical model. These rules direct when and how to execute trades. 2. Data sources. High-quality historical and real-time data are crucial. This data can include price movements, trading volumes, and market conditions, which algorithms analyze to make trading decisions. 3. Backtesting. Before deploying an algorithm, it must be rigorously tested against historical data to ensure it performs well under various market conditions. This process helps identify potential flaws or improvements. 4. Execution systems. After backtesting, the algorithm moves to the live market. Execution systems ensure trades are carried out precisely as designed, with minimal latency and error. 5. Risk management. Effective algo trading systems incorporate risk management strategies to mitigate potential losses. Techniques such as stop-loss orders and dynamic hedging are common practices. 6. Regulatory compliance. Algorithms must comply with all market regulations, as violations can lead to significant penalties. Regular monitoring ensures these rules are continually met. Now, let's discuss some popular algorithmic trading strategies. Trend following. Strategies based on following market trends, such as moving averages and breakouts. Arbitrage. Exploiting price discrepancies between different markets or instruments. Market making. Providing liquidity by simultaneously placing buy and sell orders to capture the spread. Statistical arbitrage. Using statistical models to identify and trade price discrepancies. Mean reversion. Betting that asset prices will revert to their historical means. In conclusion, algorithmic trading combines complex mathematics, data science, and financial theory to enhance efficiency and profitability in trading. While it democratizes access to sophisticated trading strategies, it also demands thorough knowledge and meticulous planning. Thank you for watching. Like and subscribe for more videos like this.